we will look at some fundamental differences between saving and investing when it comes to money management. Saving and investing are vital concepts for establishing a strong financial foundation, but they are not interchangeable. While both can help you build a more secure financial future, consumers must understand the distinctions and know when to save and when to invest. The level of risk taken is the most significant distinction between saving and investing. You will normally receive a lower return by saving, but you will be virtually risk-free. Investing, on the other hand, allows you to earn a bigger return while also exposing you to the danger of losing money. Here are the fundamental distinctions between the two, and why you should use both to help you generate your long-term wealth. Explained: savings versus investing. The act of putting money aside for a future need or necessity is known as saving. When you decide to save money, you want the funds to be available as soon as possible, if not immediately. Savings, on the other hand, can be utilized for long-term purposes, such as ensuring that you have enough money at the correct time. Savings are often placed in a low-risk bank account. Those wishing to optimize their profits should look for a savings account with the basic annual percentage yield, APY, as long as they can meet the minimum balance requirements. Investing is similar to saving in that it involves putting money aside for the future, but it involves taking on more risk in exchange for a better return. Stocks, bonds, mutual funds, and exchange-traded funds are common investments, ETFs. To buy and sell them, you'll require an investment broker or brokerage agency. If you want to invest money, you should plan on staying with the investment for at least 5 years. Short-term investments can be quite volatile, and you can lose money on them. As a result, it's critical that you only invest money you won't need right away, preferably within a year or two. What are the similarities and differences between saving and investing? As you can see from the table above, saving and investing have a lot of differences, but they also have one thing in common. They both help you accumulate money. Quote, "First and foremost, both include putting money aside for the future," says the author. To save money, both use specialist accounts with a financial institution. For savers, this entails opening an account with a bank or credit union, such as Citibank. For investors, this involves establishing a relationship with an independent broker. However, many banks now offer brokerage services as well. Charles Schwab, Fidelity, and TD Ameritrade are popular investment brokerages, such as online options like E-Trade. Charles Schwab, Fidelity, and TD Ameritrade are popular investment brokerages, as are online options like E-Trade. Both savers and investors recognize the value of having money set aside. Before committing a substantial sum of money to long-term investments, investors should ensure they have sufficient funds in their bank account to handle emergency needs and other unexpected charges. Investing is when you put your money aside with the intention of allowing it to grow for your ambitions and future. What is the difference between saving and investing? Quote, "When you mention saving and investing, most people, probably 90% of them, think they mean the same thing," says Dan Keaty, CFP, Chief Financial Planning Strategist at TIAA, a financial service firm. While there are some similarities between the two endeavors, saving and investing are fundamentally distinct, and it all starts with the assets in each account. Think about products like savings accounts, money markets, and CDs or certificates of deposit when you think of savings. Stocks, ETFs, bonds, and mutual funds come to mind when it comes to investing, according to Keaty. The advantages and disadvantages of saving. There are numerous reasons to save your hard-earned cash. For starters, it's usually the safest bet and easiest method to prevent losing any money. It's very simple to do, and you'll have instant access to cash when you need it. Overall, saving has the following advantages. Saving accounts inform you how much interest you'll get on your money upfront. The Federal Deposit Insurance Corporation insures bank accounts up to $250,000. So, even if returns are lower, you won't lose money if you have a savings account. Bank products are often fairly liquid, meaning you may obtain your money as quickly as you need it. However, if you wish to access a CD before its maturity date, you may be charged a penalty. There are no hidden costs. The only way a savings account and an FDIC-insured bank can lose value is through maintenance fees or regulation deviolation costs. When more than 6 transactions are made, out of a savings account in a month. Saving is often simple and straightforward. There is usually no initial investment or learning curve. Despite its benefits, saving has significant disadvantages. Returns are low, so you might be able to make more money by investing, but there's no guarantee you will. You may lose purchasing power over time as inflation eats away at your money due to low returns. The advantages and disadvantages of investing. Saving is unquestionably safer than investing, while it will almost certainly not result in the greatest accumulation of wealth over time. Here are just a handful of the advantages of investing your money. Stocks, for example, can yield substantially larger returns than savings accounts and CDs. The Standard & Poor's 500 stock index, S&P 500, has returned around 10% yearly over time, while the return can vary substantially from year to year. The majority of investment products are highly liquid. On practically any weekday, stocks, bonds, and ETFs can be easily converted into cash. If you have a well-diversified stock portfolio, you'll be able to easily outperform inflation over time and boost your purchasing power. The Federal Reserve uses a target inflation rate of 2% at the moment. If your return is less than the rate of inflation, you will lose purchasing power over time. While investing has the potential for larger profits, it also has a number of disadvantages, including returns are not guaranteed. You may lose your money, at least in the near term, as the value of your assets changes. Depending on when you sell and the state of the economy as a whole, you might not get back what you put in. You should keep your money in an investment account for at least 5 years to ensure that you can weather any short-term downturns. Because investing can be complicated, you'll almost certainly require professional advice unless you have the time and skill set to teach yourself how to do it. Fees in brokerage accounts may be greater. Although many brokers now offer free trades, you may have to pay to trade a stock or fund. You may also need to hire a professional to manage your finances. So, which one is more advantageous? Saving or investing? In most cases, neither saving nor investing is the superior option, and the best option is dependent on your personal financial situation. In general, though, you should stick to these 2 guidelines. A savings account, or CD, is your best bet if you need the money in a year or less, or if you wish to use the cash as an emergency reserve. If you won't need the money for at least the next 5 years and can afford some capital losses, you should probably invest it. According to Keedy, the best method to convey this is through real-life instances. Paying your child's college tuition in a few months, for example, should be saved in a savings account, money market account, or short-term CD, or a CD about to mature when it's needed. Quote, if not, people will think, well, I have a year and I'm purchasing a house or something. Maybe I could invest in the stock market. Keedy says, at that point, it's more like gambling than saving. The same is true of an emergency fund, which should never be invested and should instead be held in savings. Quote, so you don't have to go back to debt if you become sick, lose your job or whatever, says the author. Quote, you have money set aside specifically to act as a buffer between you and life. When is it preferable to invest? Investing is preferable for money that you want to grow more aggressively over time. Investing in the stock market, exchange-traded funds, or mutual funds, depending on your risk tolerance, may be an alternative for someone wishing to invest. You give yourself more time to ride out the inevitable ups and downs of the financial markets. If you can keep your money in assets for longer, as a result, investment is a great option if you have a long time horizon, preferably several years, and won't need the money very soon. Quote, so, if someone is just getting started with investing, I would recommend growth stock mutual funds as a terrific place to start and truly begin to comprehend what is going on and how money might grow. If you enjoyed our video, please click the like and subscribe button below for more financial tips.